Hey, welcome back to Beyond Business Insurance, the channel that makes you a better buyer of your business's insurance. Click subscribe below. Today I'm going to talk to you about audits. Okay, when it comes to taxes, and we turn in our taxes at the end of the year, no one wants to, first of all, be audited by the IRS. But secondly, if you are audited, no one wants to pay more into taxes, right? Usually people want money back. Now, I would actually argue technically want to pay more, but that's besides the point. So anyways, same thing can be said for insurance. Have you ever got done with your insurance policy period? All of a sudden you get a bill at the end of the period saying you owe an extra $30,000. This would probably not make you happy because you weren't expecting it, right? It's a surprise. You feel like your agent never told you. So today I'm going to talk to you about a simple concept of the insurance audit, how it is, how it works, why it exists, and how to make sure that you're not stuck with a surprise large audit. What is it? Okay, your insurance, typically your general liability and your workers' comp, maybe even auto, just depends, but are going to be based on forecasted numbers, right? No one knows the future perfectly. So you're going to have to forecast what are you going to do for the upcoming policy period? How much are you going to do in sales? What's our payroll going to be? Well, let's just say that you turn in those numbers and you have an awesome year. Well, at the end of the year, the insurance company is going to come on out and they're going to say, this is what you give us for your forecasted numbers. Here's where your actual numbers were. And they're going to charge you that same rate that they were using for the sales over here. If you did an extra $1 million, well, they're going to take that extra $1 million in sales, times it by that rate, and you're going to owe that for an audit bill. So it seems really unfair, and it can be frustrating, especially if you weren't expecting it. But this is common in insurance, right? Now, there is some non-auditable policies out there. I'm not going to get into that today. I'll make another video on that in the future. But the main concept today is that most insurance companies do audit, right? Now, on the flip side, let's say you do way less in sales. Well, then at the end of the year, that insurance company is going to give you money back. Say, hey, we charged you $30,000, but we should have only been charging you $20,000 because your exposure was down. So that's in the ideal scenario. You have an audit that can go up or come down. Now, again, there's companies out there that won't give you money back. They only do like a one-way audit. Again, I'll talk about that in a future video. But the main thing to know is that an audit happens at the end of the policy period, and they're going to take your forecasted exposures, whether sales or payroll, and they're going to just compare them to where they ended at the end of the year. And they're going to multiply that rate, and that's what you're going to owe, or that's what you're going to get back. All right. Now, the reason people get so frustrated is because they feel surprised or thrown off by this. So just know it up front. This is how audits work. This is how insurance companies charge, right, for exposure. And also talk with your agent more than just once a year. Meet with them every quarter or halfway through that year. They should hopefully be reaching out, just seeing how things are going, how your business is going. Are sales still projected to kind of be where we thought they were going to be? So that's maybe your agent's job, to be more proactive and to kind of bring that up with you and just say, hey, do we need to make any adjustments mid-year? And if not, great. But at least now you're not surprised about it. If you like this, give it a thumbs up. And again, I will share another video in the future on all of the details on different ways companies can audit. Have a good one.